Hello, everyone, and welcome to our webinar for March 2023 on Cashflow Mastery. Thanks for joining us. For those of you that have joined us in the past, you'll know who we are, but for those of you that haven't, we'll just introduce ourselves. My name's Joe Steckel, and this is my business partner, Tamara Daniel. We're from PTP, the advisory arm of PTP. So we're going to run through that in a minute, but we're going to be talking today about Cashflow Mastery. And turning profits into real cash. And we know, right now, and cash is always king in business, but right now, particularly with what prices, interest rates, the general economy and nervousness and things are doing in the big world, we know that it's a really challenging time. So being aware of this stuff is good at any time, but it's certainly vital right at the moment. So thank you for joining us. We'll get into it.
Thanks, Joe. All right, guys, just some housekeeping. Feel free as we go along, if you've got any questions, add them while you think of them. We'll be answering questions at the end of the presentation. So if you think of anything as we're going through different things, please just add them in the question box, which is off to the right. If you lose connection, simply refresh the page and re-click the link in your email, and you'll be able to rejoin at any point in time. And you'll receive an email after the session with a copy of the recording and some handouts and things like that we have for you as well.
Just as an aside, Tam, the chat box and the handouts thing, which you'll probably see to the right of your screen, got a few slides with a bit of writing and smaller stuff on them. So if you want to make that a bit bigger, feel free to just use the arrow and just minimize that until you need to use it as well.
Absolutely. So on the agenda today, Joe's going to go through some mindset stuff. We're going to go through the difference between profit and cash and why they are not the same. We're going to go through some entry level or base level cash flow tips. And then we're going to go through in more detail our advanced cash flow tips and then kind of go through some questions.
Excellent. So before we get to that, we just thought we'd run through I suppose what and who PTP is and what is within our group. I suppose within our, I think that the common term now is within our ecosystem, and we've got a number of different arms to our business. Some of you will be aware of them, but where we are today, of course, is within our PTP advisory part of it. As you see, Amy's put a little sticker there to let us know that's where we're at. Just to run through those briefly, Bookmates is our bookkeeping business that is all about data accuracy and timeliness. PTP compliance is all about our tax side of things, obviously, and any compliance sort of work. Advisory is all about increasing profit and choice and flexibility for business owners. And PTP Wealth is about investing and growing. So the way we sort of look at that is that we're supposed to step through left to right. We get data into your system so you know what's going on at any particular point in time. We can complete and minimize the tax. We use that information and other information from you and your team to increase your profit and your choice, and then we invest and grow some of the profits that we make from that. And that's the way it all steps through. So as I said today, we're going to concentrate on that PTP advisory space. So a couple of things before we get into the mindset side of it, and some of this is I suppose to do with mindset. And last time or a couple of times ago with our webinar around some of the practical tips at the end of last year, we spoke about time and the fact that some of the things that we put into place or we want to put into place, we don't do because we don't have the time or don't make the time to do that. And thinking about why that is, as far as, we know we should and we know we want to, but we can't make ourselves do that. So what we wanted to start with today was some of these things that we're going to be going through today, you will have heard before. So the first point here is be open to new things and revisiting things that you may have heard in the past. You will have heard, particularly these basic cash flow tips, that they're pretty straightforward and they're probably things that are spoken about pretty quickly as soon as you get into business, depending on your industry and what you're doing. But make sure that if you have heard them, just give it the time to have a think about, does it still apply in the same way? Does it apply more now to me? Is what I'm doing the best way to do that, or am I doing what I've always done? So just remain open to different ideas. Don't close your brain off to it. Go, I've heard that, or I've dealt with that before. Listen to and note your thoughts and reactions. So thoughts aren't positive or negative; they just are. If you know how to react to, if you know how you react to certain things, then you're more likely to be able to identify your blind spots and self-limiting beliefs. Okay. There's no doubt that during this presentation, some of the things we talk about, you will have a reaction to it, whether it be just a bit of a nervous reaction or not sure about that. This doesn't apply to me, whatever it might be. Make note of it. If it sails through to the keeper and there's no problems, that's okay. You're probably taking that in. But if you've got a reaction to it, that might be something that's blocking you or stopping you moving forward. Commit to trying at least one concept or action. So we all attend these sort of things various times, and we don't have to do everything. Quite often we try to, and the fact that we try to incorporate every single thing that we're learning from a presentation that goes for an hour means it makes it quite difficult to do. There's a lot of stuff we're going to go through here. So if you can just do one thing, or take one concept and take one action, you've had a win, because that's a step forward. Ask your questions. Utilize the fact that most people don't ask questions if you have one. So even if they have a question that they're nervous about, sounding silly, whatever it might be, there's cliched. There's no silly questions here. Please ask the question. Someone else will be thinking it, and even if they're not, please take advantage of getting free advice. You've got a couple of us here. We're happy to answer the question. We're happy to have a chat to you afterwards. Take advantage of that. And set yourself an accountability action, something I've referred to in the past as a magic step. It's to ensure that you've done something with the information you learn. Email us, talk to your business partner, something after this to make sure you do something with what you've learned. And I think that's a good tip across the board anyway. A lot of the time people say they're going to do things, not because they choose not to, they just forget about it. Because how many things has come at us every day as business owners? There's hundreds of things every day. So we can't be expected to remember everything. You need to make sure you put that thing in place to make sure you're going to do what you said you were going to do.
That's one that works for us, isn't it, Joe? We quite often keep each other accountable for the learnings and things that we do. So that's definitely a really important step for you guys. For sure.
I love this quote. This has been attributed to, I was looking at this up the other day. It's been attributed to everyone from Henry Ford to Tony Robbins to any number of different, like all these quotes that sort of attributed to different people. But I like it because it's very true, very simple, but very true. If you always do what you've always done, you'll always get what you've always got. You are where you are now because of decisions that you've made along the journey, whether that be in your business or your life. We need to own that, and we also need to understand that if we keep making those same decisions, we're going to keep on the same path or be in the same spot. That can be a bit confronting, understand that, but again, this is not to be a comfortable session. This is to actually create change and to help you think through things. So maybe just reflect on that and have a think about, because we're going to ask the question later, what are we going to change? What's that one thing we're going to change in order to get a different outcome? All right. So our first question, it's a bit of a poll question. Amy's going to put a question up on the screen for you to interact with. Should be able to select an option. So Amy, if you can do that now for us, that would be great. So you can see there, what is cash flow? And we're just trying to gauge your understanding of what cash flow is. And there's three options there. There's a measure of income invoiced and expenses incurred, measure of amounts collected and amounts paid, or the amount of cash you've got in your bank. So if you can answer that question now for us, that would be great. We'll give you about 10, 15 seconds. Just long enough to answer it, but not long enough to Google it. Oh, wow, we've got some gurus here.
All right, we might publish the results, Ames.
All right. Amy, we're okay to finish that poll up?
All right, so there was no one, I suppose, selected amount of cash in the bank, which is correct. A couple of people selected the option of measure of income, invoice, and expenses incurred. and which is actually the definition of profit, which we're going to go through in a minute. And then 83% of the room has selected the correct terminology, which is the measure of amounts collected and amounts paid. So we will go to the next slide. Not sure what's happening with that.
That's all right. I think we can see that. You can see the profit versus cash slide there.
Yep, beautiful. All right, so guys, as we just went through, profit, cash flow is measured in what kind of comes into the bank and what goes out of the bank. So your receipts and your payments. The difference between cash flow and profit is that your profit is your income less your expenses. So quite often there's lots of other outgoings that happen that are not classified as expenses. So things like loan repayments, HPs, GST, tax debt, drawings, those sorts of things also come out of the bank and affect your cash flow. And that's why there's a difference between profit and cash. So a business needs to be able to be profitable in order to generate strong and sustainable cash flow. But not all profitable businesses have a strong cash flow. And the easiest way for us to explain that is by using two examples of two different businesses that are on the same project with the same profit margin, but they have different results. So the project details are that there's $100,000 worth of income to be invoiced on this project, $70,000 of expenses. Of that $70,000, 45 is labor and 25,000 is materials. So they're making a profit of 30,000. Now, business number one has already got a really good cash buffer at the start of 50,000 before they commence the project. They negotiate at the, quoting stage and invoice a deposit of 20% payable, which is payable within 7 days from the contract being signed, and then they also have a further 40% progress claim on completion of a clearly defined hurdle that they are confident that they can meet at the end of month 2. Then they invoice the remainder of the 40% with a strict 30 days following completion. So you can see we've demonstrated here month 1, 2, 3, and 4 as to where the cash comes in and where the cash goes out. So in month 1, they have $40,000 worth of payments going out, and they only collected the 20 grand worth of deposit. So they're down 20 grand. The next month they collect that progress claim and don't have as much payments or outgoings going out. So then their cash boosts up a little bit. Month three, they don't have any income. They've just got expenses. Their cash goes down. Month 4, they get the remainder, and they're relatively the whole way along, their cash balance is still a positive, still in a positive situation. Business B actually has slightly higher cash buffer, but they were a little bit, but they didn't, organise any progress claims or any deposit. So they are a little bit concerned about how they're going to carry the cost of the project, but they know that they're going to make 30 grand out of it at the end, so they're happy to kind of do the work. They've negotiated 7-day payment terms on completion of the project. And you can see the difference here in the cash flow of this project, that even though they had a really good healthy bank balance at 55 grand at the start, by month 3, they're into their overdraft. And it's not until month 4 that they then recoup that. So this is a really simplistic explanation. And obviously 99% of businesses have a lot more than one project or one service going on at any one point in time. But it's really important to understand that, if you're doing this with, 3 or 4 different projects, the massive impact that's going to have on cash flow. Doesn't matter what, you can apply this to different industries such as retail, construction, beauty, whatever it is, there's different cash cycles for what you have. So it's just really good to, be mindful of what happens here.
And you can see here, Tam, the going back to the cash balance of nil at month 2. This is obviously assuming this is just the cash flows for this project. These guys are going to have monthly overheads. They're going to have other expenses. They're going to have to go out as well. And you can see pretty quickly how even though businesses are working on a profitable project, they can go broke. Because if they don't have a cash reserve, or as you said, they don't have an overdraft at month 3, they want to have some money put aside personally or be able to access some money somewhere pretty quickly, because otherwise they're not going to be able to get to finishing the project to be able to collect the other 85. So you can see, all these building businesses and things that everyone will have heard about in the news over the last little while going broke. This is how it happens. Not on individual projects, but this times 1,000, and they end up in a position where they just can't finish the projects, even though they're profitable. They can't finish them and they fall over, and that's the key with cash flow. You'd be very profitable, not have the cash.
Mm-hmm. Absolutely. So same profit, but very different cash flows between those two businesses that we just went through.
That's okay. Okay, you can be as profitable as you like. So we've all heard the saying, cash is king. Can mean any different things. It's absolutely applicable to business, obviously, because you can be as profitable as you like, but if you haven't collected that profit, i.e. been paid for your invoices or been paid for selling things, then you're simply not going to have the cash to pay your bills. And that's what it comes down to. If you can't pay your bills, then it's hard to keep trading, obviously, because people aren't going to keep giving you things or supplying you with things if you're not paying. Positive cash flow simply means that you are collecting more money than you are spending. In short, your bank balance is increasing over time. Why is this important? Because you can fund growth and investment inside and outside of your business. Growth costs money because all these things you've got to invest in. So if you're going to grow your staff team, quite often you're shelling out for wages before perhaps that person's producing income, or people are producing income. If you're going to grow the amount of stock you've got on hand, well, you've got to buy the stock and fund that before you can then go and sell it, turn the profit over to pay it back. So growth always costs money, and you need money aside in order to allow that to happen. You don't have the mental burden that cash flow stress brings. This is a huge one. And look, I'm sure many of you, many of our clients and many people we've spoken to over COVID felt that. And it really does impact your ability to be able to do any number of different other things in your business or make effective decisions, whatever it might be, makes everything harder. And it's a bit of a vicious cycle, because if you can't make good decisions or you can't make any decisions, you're sort of a bit stuck in a fog because you're stressed from cash flow. That can then add to the cash flow stress. So it just goes round and round in circles. You can take advantage of opportunities of opportunities that others can't, perhaps. So if you've got cash in the bank and something comes up where business is for sale, you can pick up some stock cheap, you can invest in something, whatever it might be, you're in the position where you can do that when you've got cash in the bank. Now, if you don't, that's why a lot of people can't take advantage of opportunities even when they see them, because they can't fund the opportunity. Opportunities quite often cost money, and if you haven't got the cash to do that, then it's not an opportunity for you. It's just it's a lost one. Anything further to add there, Tam?
No, that's all good.
Now, just to muddy the waters a little bit, I know we said profit and cash flow are different things. They are, but it's important to understand the impact that profit has on cash flow, because it does have a significant impact. So at the top there, you said your business will not be able to achieve excellent cash flow if it is not profitable to begin with. So know your numbers, check the following, or reach out if you're unsure. So we're not going to go through these in huge detail, because this is probably more accounting terminology, but it is important to understand your gross profit margin, which is really your profit after you've sold an item of stock, or you've paid your direct labor for doing that job, whatever it might be. Your net profit margin is your profit left after all of your expenses, your overheads and everything. It's amazing, and I'm sure you've experienced this, Tam, amazing how many people don't realize how many dollars out of 100 coming in the door they're keeping at the end of it. So I still remember I had a conversation with a client back years ago, and we spoke to them about the fact that they were keeping $10 for every $100 that was coming in sales. Because they're looking at their sales and going, we had $5,000 sales today. That's fantastic, and it is. But when you put it into I suppose perspective for them and say, well, of that $5,000, you're actually going to end up keeping $500 of that. it makes a very big difference to their mindset around how they can use that $5,000. And most businesses operate somewhere between 5 and 20% net profit margin. So it's not huge. It's, for every 100 that's coming in the door, you're keeping between $5 and $20. So some are more than that, but they're sort of unicorns. So most people are running at that level. So just be aware of that. Your monthly overhead, they're expenses incurred in keeping your doors open. So rent, no matter how many sales you make, you got to pay for these overheads. And then your break even point. So know what your minimum income needs to be to break even or cover all of your expenses. Now that's effectively your net profit margin of nil. That's what that looks like. So you're not going backwards, you're not going forwards. The good thing about this stuff is that there's not actually that many things you can do to change them. There's nuances in all these things, but there's only so many levers you can pull to change these numbers. And we're going to go through that in a bit more detail later on. But our gross profit margins, we can increase prices or our charge rates, or we can reduce our supply cost. Really, that's all we can do there, because we're just trying to open up the profit we're making on the sale. Net profit margin, we can increase our gross profit margin per above. We can increase our volume of sales while keeping our overheads at the same level. So that obviously it gives you more top line income. Keep your overheads the same, your bottom line income grows, and you reduce your monthly overhead as well, because obviously that's reducing your net profit. And you're removing your monthly overhead, or reducing your monthly overhead is reducing all your unnecessary or non-income producing expenses. Not that simple, but for the sake of this discussion, that's really just cutting out the expenses that you don't need in your overheads. Again, people will be fairly au fait with that, because a lot of people had to do it over COVID.
Yeah, and I think it's really important, Joe. I know that nearly most business owners that I talk to, when they start to have cash flow difficulty, they actually focus on the monthly overheads. Instead of actually pulling some of these other levers that are going to have a much better impact to their bottom line. If you ring Telstra and renegotiate your phone bill and it comes down by a couple of $100, that's great, but that's not going to have as much of an increase to your bottom line in your cash flow as say maybe a 2% increase in your gross profit margin is going to have. Yep. So just be really mindful as you go through this that that's nearly one of the last things that we suggest to do, or that is one of those things that you keep on top of all the time. But some of these other suggestions are going to have a much bigger impact for you.
Yeah, and we're going to provide a tool later for everyone that's attending here today to give you an idea of, to enable you to put your numbers in there and give you an idea of how much difference all those things make across the board, because it is, as Tam said, that it's a combination of all of them. But people do jump to that easy one of trying to cut expenses, and it's not always. In fact, it's rarely the best or most effective place to start.
Yeah.
Okay. Speaking of later, we're here now. So the original expenses here on the left-hand side is what a business was, say, turning over prior to making any changes. So we've got $1 million of sales. We've got our supplier costs, so our cost of goods. 500,000. So our gross profit margin here is 50%. That's not too bad, depending on the industry, but that's around the mark. So 500,000. We've got overheads of roughly 25,000 or so a month, and our net profit there for the year is $200,000. Our break-even point, so what we need to sell just in order to cover our overheads, 600,000. Now, we can see here, and as I said, we'll give you an editable spreadsheet, which I think Amy's going to put in the downloadable documents now. She's just done that now. Feel free to grab that. If we just change this slightly across the board by 2%, very, very minor. We increase our sales volume by 20%. We increase our prices by 2%. We reduce our supply direct costs by 2%, and we reduce our overheads by 2%. So you'd see very, very minor changes, very minor. Look at the net profit line. We've gone from $200,000 one year to $256,000 the next year. That, to give you an idea, even just remove. So if you said, well, I'm not going to do any of these things, I'm just going to reduce my overheads by 10%, which is big. That's a lot to reduce overheads by. that wouldn't even get close to this 260,000 or that 60,000 roughly gain. That would give you $30,000 gain. And there's a lot of work in that, and a lot of downside to potentially frustrating suppliers and frustrating people, or not necessarily getting the best outcome, or cutting things out that don't need to be cut out, or that have other impacts in your business. So that's what we're saying, and Tam, you said it really well before, is that this is not just a one shot thing. It's across a number of different lines, and you'll know yourself. And if you don't, we can work with you to help you figure that out, where you're going to be able to up the ante a little bit with some of these. So maybe in your business, you can increase, you've got room to increase your sales in your market by well more than 2%. So we'd focus there. You might know that you're underpriced a little bit and you want to bring that up a little bit. Well, there might be some room to move there. So you can see there, minor changes across the board make a big difference to the bottom line.
Absolutely. But it's just really important to also point out, Joe, that if we don't know our numbers, and if we're not across this as business owners, it's very common for costs in our businesses to have gone up by 5 to 10% in the last 6 months. And if we haven't changed anything ourselves, if we're absorbing that cost, that's just gone straight down to our bottom line. So it's really important that we, as business owners, are really proactive in this area. And unfortunately, this is an area that in the last couple of years, everyone's been still riding this COVID bubble. And we've been all so busy, and cash flow hasn't been too much of an issue. But we've really started to see that in the last 3 to 4 months, that it's starting to get tighter and tighter because people haven't had their fingers on the pulse.
Yeah, for sure. And as you said before, it can easily go the other way. So if you reduce or increase your supplier cost, because that's what's happened, as you said, the obvious downside to that is if you don't change the prices, your profit's decreasing. Without even knowing about it. And it can happen very quickly. And that's where having that finger on the pulse and being aware of what those numbers are is so important.
Absolutely. So you cannot have good cash flow without having good profit fundamentals. So know your numbers. That's kind of what we were just talking about. It's really, really important to not get caught up in the busyness of working in your business. We need to be across all of the, I suppose, financial side, and being able to give you guys time to work on your business and actually know these numbers.
So if you don't know those numbers, please reach out either to us or to the accountant that you deal with, to your bookkeeper, to whatever that looks like, so that you can get an understanding of what that looks like, and you get it regularly. So you should be able to get that information monthly. Not every single detail of what's going on, but you should be able to get those key lines on a monthly basis, so you know exactly what's going on. Some businesses will even need it more than that, but monthly should be fine for most people, and that's pretty achievable.
Absolutely. And guys, it's not, necessarily looking at that whole profit and loss that Joe spoke about, everything. Just having a look at those key levers that we've provided a couple of slides ago. They're the key ones for you to be like, yep, this is improving, or this is not improving, or this is decreasing compared to what it had been in the past. We need to make some changes. And if you're onto it, at a minimum monthly, but again, some businesses are going to need it more than that. But if you are onto that in a really timely manner, then you can make tweaks without it being too disastrous for your cash flow. All right, so we're going to go through some entry-level cash flow tips. Now, this is what Joe and I suggest as being baseline. So a lot of this is probably things that you may have heard of before, so I am going to rush through it pretty quickly. But these are fundamental things that you should be doing regardless. So focus on maintaining consistent levels of sales and invoicing. Invoice at the time of the service or the sale. So if you're in a business like a service-based business or something like that, don't wait days or weeks or even months to do those bills. I know we all get busy and caught up doing the jobs, and bookwork isn't the funnest thing to do. I know that myself, but we cannot leave weeks or months before we start billing that, because that's going to impact your cash flow. Be clear about your debtor terms and have a clear process to enforce them. So essentially, if you've got people that owe you money, you've already paid for the materials, you've already paid for the labor, or you've already paid for the stock, you need to get that cash back in. So if you know you're not onto your debtors and you're just letting them go, that's going to be impacting your cash flow. Regularly review and cut unnecessary non-income producing expenses, so those overheads. Minimize direct cost of goods expenses by seeking better prices, volume discounts, or just talking to your suppliers. Quite often, it's very easy to ask a question, and they're very receptive in being able to give you a little bit extra. But if you don't ask, you don't know. So definitely, always shop around or look for that. Speaking to your bank to see if they can possibly help restructuring things. I know we've helped different businesses with trade finance or overdraft due to their cash cycle with different projects or something like that. Look at, if you need a credit card or a loan that you might be able to consolidate. So definitely that is an option. Joe and I would never recommend going into more debt to keep funding cash flow if you're not on top of why the cash flow is bad, but there's definitely some things that you can do in that area that will help even out the cash flow. Utilizing interest-free periods on credit cards to keep the cash in your pocket. So things like, paying for everything on credit card, you might get 30 days interest-free or something like that. And paying for your invoices at the due date. Instead of when they come in, they may not be due for 30 days, but actually knowing, being aware of what cash is coming in and when you can make payments without compromising that cash flow is really important when you're having some difficulties. So pay on the payment dates or negotiate longer payment terms if needed. Payment arrangements or just longer payment terms. If you say doing a big job and you know that it's not going to line up with the income, maybe you can say, just on this invoice, can I have an extra 15 days or something like that. Suppliers are pretty good if you communicate with them earlier. So advanced cash flow tips. So these are some of the ones that you may not have had as much had much exposure to, that we're going to go through in a little bit more detail today. So having a look at your charge rates, your pricing or your margins, your work in progress, understanding what a cash cycle is and what is your X. So Joe's going to run through a document that we've got to explain that. Inventory, the use of buckets or holding accounts. Anyone that kind of works with PTP quite regularly will have probably some buckets or something like that set up or something like that. And the importance of forecasting and knowing, I suppose, what's coming ahead. All right, so you probably won't be able to see this little diagram very clearly, and apologies for that. We can provide it afterwards if you like, but I don't know how many people in the room may have seen this. This is a bit of a Jeff Everest special. It's one of our BA educational documents, and it shows the cost of an employee in a few different steps, taking into consideration their wage, what add-on costs there are, how much they actually work and how productive they are. So quite often when we ask someone how much is that person getting paid, they'll be like, oh, $35 an hour. And it shows here that $35 an hour very quickly turns into $40, $43 an hour when you add your super, work cover, payroll tax. Then if you actually then consider that's just per hour over the whole year. If you then consider how much they're actually working, because there's public holidays, there's annual leave, there's sick leave. So they actually only work out of a 52-week year, 44 weeks. That actually increases their hourly cost to $47.78. If they are not 100% productive, if they're, say, a chargeable employee, that increases the more unproductive they are or the more that you can't charge them out. So it's a really powerful document to be able to explain charge out rates. So happy to, if someone would like to run through this, just yell out to Joe and myself. But you can see that at the end, if they're only 60% productive, they're actually costing you nearly $80 an hour, and you haven't factored in any overheads or any contribution to overheads. So this is why charge rates are really, really important to understand what actually is the effect of things throughout the cycle. So quite often charge rates are not what they seem. They are always increased and consistently moving. So overhead expenses rise, wages rise, and productivity can fluctuate with staff. So it's really important to carefully monitor these quite regularly and make changes where you need to. And you may have different charge rates for, I suppose, different projects or something like that as well. So just be really mindful to keep the finger on the pulse if you are a service-based business. So like, plumbers, builders, any, manufacturing that you do charge labor for, even something like, a beautician that charges services and has like a cost of employment in there. It's really important that you're across knowing what this number is for you guys.
All right. So just to go back to the start of the presentation, that mindset thing, we're talking about increasing charge rates and increasing pricing. This is probably one of those things where the hair on the back of your neck's standing up. I would suggest, because it is for a lot of people. So just sit with that. That's okay. But increasing pricing, very similar to charge rates. Prices need to be constantly reviewed to maintain your margins. So if you think back to those previous slides when we were talking about your gross profit, net profit margin, if your overheads and supply costs increase, you have two options in terms of your pricing. You leave them as they are, so you don't increase your prices, in which case you incur the increased cost and reduction in profit directly. That's going straight to your bottom line. Or you do increase your prices, in which case you pass on some or all of the increased cost and retain some or all of your profit margin. Now, that doesn't mean you pass on all the costs. There's some strategy to that. There's some things that, there's some nuance to that, obviously. But just being aware that is a choice that you have. You can, and you need to make that. You either wear the cost increase and it's going to your pocket or coming from your pocket, or you increase the prices and maintain that margin. Depending on your business and the length of the cash cycle, increasing the prices and charge rates can have a fairly immediate impact on your business. Obviously, if you're a longer term provider like a builder or someone like that with a long cash cycle and projects already on the go, you can't just, most projects you can't just randomly increase your charge rates in the middle of, because you're probably quoted for that. But a business like a retail business is going to immediately notice a price increase because that's just going to increase their sales from day dot in terms of the price they're getting for the goods they're selling.
Absolutely. I think it's really important here, Joe, to also mention that if you are like a retail-based business or even a service-based business, that you are trying to sell at that recommended retail and not discounting, because I know quite a lot of retail-based business will discount just to keep the stock moving. So we're going to talk about that a little bit further, but trying to make sure that you are not discounting too much. And same with service-based businesses. The amount of service-based businesses that I talk to that are only doing cost plus 20% instead of recommended retail is massive. So just this here doesn't even need to be too much of a tweak. Just trying to sell at recommended retail is a really good start.
Yes. Work in progress, one of the most invisible and biggest cash flow killers. So it's common in service, construction, manufacturing businesses, anything really with a really long lead time between when you start incurring expenses and when you invoice. That's what your work in progress is. So broadly speaking, it's a really common and understood practice in professional firms, like accounting, lawyers, those sort of things, because we keep track of these things. It's easily measured, but it's the cost of materials and labour that has been incurred and or paid for on jobs that has not yet been completed. So this is money that you've spent, but you have not yet invoiced. So if we think back to that original project, original example where the business has incurred upfront cost on labour and also materials with that project they were doing, that's work in progress. So and you could see the difference between company A or business A and business B. Business A kept control of their WIP because they invoiced for a deposit, they invoiced for a stage payment, they invoiced at the end. So their WIP balance was kept at a relatively manageable level. It wasn't tied up. Their cash in their business wasn't tied up in expenses to do with that project. Whereas if you look at business B, all their cash, or more cash than they had available in their business, was tied up within the project. Now, yes, they still make the same amount of profit at the end of the day, but business B really struggled to get there. Business A quite comfortably got there because they managed their work in progress. And that's really what this is about. It doesn't have to be a business with really long lead times. It can be a business with slightly shorter lead times, but lots of projects. Same challenge as well. So just be mindful that you incur a lot of costs for things, and it sounds obvious when you talk about it, but you incur a lot of costs of things, and out of pocket costs, not just invoices, out of pocket costs for things before you invoice for them. So the amount of that you incur will directly impact your cash flow. So
absolutely. And I think WIP is a really big one that has blown out a lot more over the last probably 12 months with short supplies and not being able to get hold of materials and things like that. It's something that has been out of a lot of business owners' control. So that's why it's really important to really spend that time knowing, I suppose, what that cash cycle is, to know if you need to tweak some progress claims or deposits or bring forward a deposit or something like that, really knowing what that effect of say that project or that job is going to be, because WIP is something that has been a huge blowout for most of the businesses that I work with.
And you might look at this and say, well, I'm a retail business, work in progress doesn't impact me, and you'd be right. I look at actually work in progress more like the challenge as a very similar challenge for service businesses as inventory management is for retail businesses, because it's cash tied up in an asset that you bill eventually, but it's just when you get to bill for it. And in the meantime, it's tied up in either costs on jobs or stock on a shelf.
Mm-hmm.
So considering interim or stage payments as part of the agreement for taking on projects, and also be aware of cash reserves that will help fund short-term negative cash flow. So you could see there, again, in those examples, both those businesses had a very similar cash buffer. One ran out of cash, the other one did not. But just being aware of, okay, well, yeah, there might be some projects we take on, and this is part of the opportunities thing we spoke about before. We can take a project on. We're happy to do that. We can fund a relatively short-term negative cash flow because we've got money in the bank and we know we can do that. Therefore, we can take the project on and get to the end and make that profit. Whereas some businesses without that cash buffer can't take that project on. Cash cycle. What is your X? Every business has an X, the length of time it takes for them to collect or for them to complete a transaction. Now, we're going to go through this in the next slide in a diagram, but for some, it'll be shorter. So a cafe, if you think about a cafe, they, generally speaking, buy food or create food, buy ingredients to create food, and they sell it, generally speaking, the same day. So they don't have a lot of stock on hand because they need fresh stuff. They need things that are, that turns over pretty quickly, and they're paid most often, unless they're doing catering or something like that. They're paid for when the person buys it from them. So there's no debtor terms or anything like that. It's basically, well, I've sold you a sandwich or a coffee. You give me the money, off we go. Others will be longer, a commercial builder. So that might be a project like we went through in the example earlier. So knowing your X is as vital as knowing the profit measures we spoke about before. So let's have a look at that. Again, sorry for the size of this. Amy's going to give this to you. We have got these for a number of different industries because they do look, as we said, they do look different. This is for a service industry. And you can see there from day 0, from when a quote's done, to day X, which is when the payment's received. There's a lot of steps in between here. So, we go from quote stage, we win the job. Obviously, we've got some cost in that. Probably not a lot of cost. It's probably someone's cost to just quote it, go and have a look and that sort of thing. So it's relatively minor at that stage. We win the job, then we prep the job. So this might be, let's assume this is an electrician business. So they might have won the job. It's a reasonable sized commercial job. They've got to buy the materials to be able to do that. So there might be wires, switchboards, whatever it might be. And then we've got labour costs, obviously, to go and get that, put it into place, and do the job. Then we've got our job completion. So again, we've incurred labour cost here, and then we invoice it. So if Tam said before, if you invoice this straight after it's completed, that speeds it up. If you invoice it a month later, well, you just had 30 days straight on top of your cash cycle. And then we receive our payment, and we've got strong terms. So thinking through this, there's KPIs at the bottom here that tell us what things we'd need to focus on to improve that. But really, it's all about just reducing and keeping as low as possible this A, B, C, D, and E along the bottom here. all of those different areas, in order to keep that total length of time as short as possible. And all of those things, we've already spoken about strong debtor terms, invoicing at a particular time, keeping on top of WIP and interim billing, and understanding what that looks like. All these things come into play in this document, and that they all, as you said before, with our percentages on our GP and net profit, small changes across all of these will make a big difference to the length of time that you're waiting from when you start the job to when you collect the cash.
Absolutely. And as Joe said, we do have these for a number of different industries. So just yell out if you are not a service-based business and would like the one for your industry. Beautiful. All right. So inventory. So more of like a retail-based, I suppose, businesses or some service-based businesses are going to have stock on hand, and it's a huge cash hole in a business. So most businesses need to be able to pay for the stock well before it's sold. You might have to indent, or you may have to order to keep the stock on the shelves. It also means that you're going to be left with dead stock potentially at the end that doesn't move, that you'll need to sell well before what you should, to kind of well below what you should, to be able to get some money back. So with inventory, we suggest that you should be trying to implement a few things to be able to assist with keeping this as low as possible. So the one thing that I speak to all my retailers about is really, really knowing your data and reviewing those reports. So to see what is actually selling, and you're not kind of, I suppose, keep accumulating stock on lines that you've already got stock for. It's really easy when a sales rep comes in and they're like, oh, this is the new range, and it's really pretty and it's beautiful. And you go, oh yeah, I'll have, 5 of everything. But you've still got some stock out the back in the storeroom, you've still got some stock on the shelves, and you don't really need it all. So being onto your data will help you with that. So be conservative with indenting stock orders, particularly in the current environment, and survey customers to get their thoughts on what they want you to sell. Maybe, upload some pictures of what it looks like, and get their thoughts on which options they might like. Instead of buying, all 5 options, maybe just narrow it down to 2 or something like that. Implement reorder quantities. So, and maximum quantity. So if you maximum carry something like a 10 on hand, you only reorder when it gets to a 1 or a 2. So having some rules in place, particularly if someone else is starting to do your ordering for you, or if you have, say, a purchase order person, that will really, really help control by giving some rules. And it's quite often something that isn't done. And if it's not you as a business owner doing it, they don't have the same, I suppose, care factor when spending your money that you would. So rules around that is really, really important. Space out orders, so it's not all in one lump time and all the invoices are going to be due, say, next month. Negotiate some longer terms with suppliers. I know that with a lot of my retailers, they went to trade fair just recently, they ordered up and it was great, they were really happy, but some of them got invoiced before the stock even left the warehouses. So sometimes you might have to negotiate some longer terms if you're indenting and things like that. And also another tip is to try and find out if there's free into store or minimum orders, so that you can reduce on the shipping cost or freight cost. Rightio. Joe, you were going to do this one? Okay.
So we'll boost through these next couple, so I've got plenty of time for some questions. If you have thought of any questions now, please feel free to put them in. Don't wait until right at the end, or you give yourself a chance to forget what they are. We've got a couple we've got there, but please put them in. Use of buckets or holding accounts can be as simple or as complex as you like. It allows you to ensure that the money for future liabilities is put away and is unable to be used for funding operating expenses. So you don't have that temptation of doing that. It's an effective early warning system about cash flow and profitability. So if you can't put money aside to pay your BAS or super or something later on, that's a bit of a red light or a warning sign that something is maybe not going quite right somewhere else. Consider it at a minimum for your statutory payments. So your BAS and your super, reduces the impact when those large bills come along. A lot of clients run into that challenge where, we think we're doing okay, and then all of a sudden we get a $30,000 BAS bill. That's for them completely out of the blue. Sometimes because they're in a position where that's from 4 months ago, so you've sort of forgotten about how the trading's gone for that period of time. And when we run through it, they sort of understand it, but it's like, well, I wasn't expecting it, so it always hurts a bit more. If you already put that money aside, and you know what's in the bank and what's actually available to use, then you're more likely to feel in control and calm about that. Particularly important for businesses with large or growing numbers of employees. So big trap, superannuation, withholding tax, you only pay your staff net, the net amount of their pay. You've got to give the rest of it to the ATO later on. You've got to give the super to their funds later on. The ATO is all over that now with single touch payroll. You've got to be more than aware of how much that is and be ready to pay it within due dates, or they'll come knocking. There's just no question about that now. It's not a case of if, it's a case of when. Importance of forecasting. You've probably heard this from us, and your accountant 20,000 times, but it's very, very important. We're going to provide a bit of a link in the email to follow up this presentation to another presentation that Brian and I did in Sydney to the Business Blueprint community, purely about forecasting and why it's important and how, I suppose, how detailed we would recommend you go and why it's worthwhile having a look at. So it's important for all businesses, but particularly for new ones and growing businesses. It allows you to be able to take proactive steps. You can stress test it, and we liken it to Google Maps for your cash flow. Yes, you're crystal balling a little bit when you go out 12 months or beyond that, but at least you can make some reasonable, educated guesses, and you can try and see what happens. Okay, if this happens, if we lose a customer, if we lose a key team member, what happens? What's the impact on the cash flow? You've thought about it before it's even happened, and you can very easily react to it when that comes around, if it comes around. It allows for identifying other opportunities that may not be seen without going to that level of detail as well.
I think one of your points there, Joe, getting your advisors or senior team members to stress test it is really important, because you could even if, say, you're a beauty-based business, you could even look at what potentially a drop in 10% of sales might be as inflation goes up and people might be having less discretionary spending. You can see what effect that might have on your bottom line, to see what levers you may need to pull if you start to see that happening. So I think it's just really important having that education and knowing what that looks like.
For sure. So in summary, it's pretty easy. We just increase all the good stuff, money coming in, and we decrease all the bad stuff, money out. So I think that's the secret, and it's probably that simple, isn't it? Tam, do you reckon it's that simple?
Well, yeah, so simple, Joe.
We know it's not that simple. If only it was. Yeah, this comes back to the mindset stuff. We all have all sorts of fears, concerns, stories that we're telling ourselves about some of this stuff at the moment, or that we've told ourselves about it in the past. Some of these might appear familiar. If I increase prices, charge rates, customers will leave. If I ask for deposits or stage payments, then I will not win the contract. If I can't reduce my stock lines because the customers love the variety, and also because the business owner loves the variety, and that's part of why they do what they do, because they just love the stock. It's interesting to them. Mm-hmm. I don't want to bother that person about the money they owe me because I know them outside of work, and it'll be awkward. Particularly applicable in small communities. That's absolutely true. I don't want to be seen as someone who is just focused on the bottom line or money. I don't want to appear to be greedy. And they go on and on and on. Like everyone's got them. It's not something that anyone's immune from. We all have our stories that hold us back. But hopefully you've made some notes of the parts of the presentation that had some sort of reaction to, because they're going to be a good place to start to understanding where those blockages are. And we all have them, as I said, they're all valid and they're very real for us. So it's no good for us to say to you, well, just don't think that. That's not going to happen. We need to work around that, and you need to be comfortable. And to be able, we call it the sleep at night test. You need to be able to go to bed and feel comfortable that the decision you've made is the right one for you and your business. The question is, we go back to that. If we don't change anything, we're going to keep getting the same result. What are we going to do? What are we going to do about these concerns and these beliefs that we've got. But some possible options here. If we do nothing, we might not we might be quite comfortable that there's nothing holding us back and we don't need to worry too much about it. So we keep that status quo. That's fine. We find ourselves an accountability partner. That might be a business partner, a trusted friend, your husband or wife, leader in the team. Talk it through with them. Or reach out to us. We're happy to assist. This is what we do every day. So we're happy to have an initial conversation. We've got some different offerings here that we help clients with. And this is part of the things for moving through some of those blockages to start to get different results, because you'll only run and operate your business based on your view of the world as it is now. So if you're going to change that, we need to upgrade some of those views or change them around a little bit so that you get a different outcome. So let us know if you reach out to us if you'd like to discuss any of those things. I won't go into too much detail on those.
So what are you going to change to get a different outcome from what you've always got? Kind of going back to that quote from Joe at the start of the session. So here we've got a poll. So which of the cash flow tips that we've gone through today will you be implementing and trying in your business? So we've got charge rates, price increases, accurate forecasting, awareness of WIP, inventory management, or the use of a bucket system. So if you could go and answer those, that would be great.
We'll give you about 20 seconds and we'll move through to some couple of questions we've got there. Excellent. So we've got a bit of a spread there. Didn't draw any interest in the work in progress conversation, but that's okay. That might be an indication of the type of businesses that we've got in here today as well. So the winner there is the charge rates and price increase. I think that's one that's pretty topical at the moment because there's a lot of businesses doing it. It's a relatively good environment. Whilst it's a difficult thing to do at times, it's a relatively easy environment to do it because you're not alone. You're not making that move alone. So that's good. Accurate. Mm-hmm. Sorry, go ahead, Tam.
No, I was just going to say it's a bit of an easier pill to swallow at the moment because everyone is increasing those prices and everything has gone up. So it is a bit of an easier one to kind of be doing at the moment, as Joe said, because everyone else is. So
we've got some accurate forecasting. That's great. Please, those people, check out the presentation that Amy's going to send a link to. There'll be more detail in that one about that. Again, happy to assist with that. A bit of inventory management there as well, and the use of the bucket system. Feel free, again, to reach out to us or your accountant or your contact. They'll be able to help out with any of those things.
Absolutely. Okay. Beautiful. So in summary, guys, if nothing changes, then nothing changes. So we want you to focus on one or two of those less conventional cash flow tips and really be aware of what levers you can pull in your business. Know your numbers. And if you're not sure of what numbers you should be looking at or how to even find those numbers, we did, have that earlier on as to what some of them could be, just reach out so that we can kind of educate you on understanding those numbers. Understand what levers you can pull, check and ensure that you are following all of the conventional baseline cash flow tips that we said. And as I said before, focus on one or two of those less conventional ones. Be aware of your fears, blind spots, or limiting beliefs and find a way to accept and work on them. So if, you're looking at increasing your pricing or something like that, and it's just not sitting well with you, give us a call. We can talk through it. Do some market research as well, because you might find that a lot of businesses have like a fear of putting their charge rate up, for instance, but when they look at the market, everyone else has increased lately and they're well below market. So have a bit of a look at what that is. And just because the market is where it is, you may have higher overheads or something like that. So it doesn't mean that you can't also be above market. And take action on at least one thing from today and take steps to keep yourself accountable. So email us, email your accountant, your business partner, whatever it is, make a promise to yourself to implement something from today's session so that it makes it worthwhile.
All right.
Has anyone Got any questions?
We've got a few in here. So we're just going to run through them. We've got 3 we'll answer. And any others, please feel free to put them in. So we're going to go over by a couple of minutes just while we quickly go through these. Tam, I might get you to answer this one if that's okay. Just Amy's put a question there about how does the cash cycle differ for, I think this is one of the ones we received beforehand. How does the cash cycle differ for retail businesses?
So it is very different to the service-based one that we've got, because there's obviously indenting of stock. The stock comes in, you've got to pay for it, and then you've got to wait for it to be for the sale to occur. Usually then at that sale time, you generally get it in unless you've got invoice terms. But again, look back at some of those tips on that inventory management, look at those product lines, look at your data, what's moving, what's not moving. Don't continue to keep building that inventory base. It's something that I know for a lot of retailers has blown out in the last 12 to 24 months. And it's something that we really need to be pulling back on, particularly going into this very uncertain economic environment. So I would be starting there.
Excellent. Thank you. Okay. Maddie's got a question here. Do you have any tips on how business owners can measure staff productivity? I'll grab that one. So there's a couple of things there. It really depends on how complex you want to get to. There's plenty of programs out there that allow you to measure that. It really is going to depend on the individual business and how much or how accurately you can do that within what you do day to day without causing too much of a disruption, and also how much of a difference it will make. So there'll be some businesses, for instance, where just estimating a reasonable amount based on what the employees are producing will give you enough data to be able to make a decision. There'll be some businesses where recording every hour, I work with a number of trade businesses, as is Tam. We need to know how many hours staff are putting onto jobs, for instance, for job profitability. And that then gives us the data for how many hours they're actually clocking into productive work versus driving around between job sites and those sort of things. So it depends. There's industry software for that. There's specific software within Xero and within that sort of database of programs there that allow you to do that. If you're not sure, then or you want to know more information about that specifically, please reach out. But the answer is it's different for each business. And cash flow forecasting apps. Stephen, thanks for your question. Are there any cash flow forecasting apps worth using? The number one, simplest one, which is probably the best one, is Excel, Microsoft Excel. That's probably okay for 90% of businesses. It's a little bit manual and it's a little bit of setting up. But once you've got it set up, it's pretty straightforward to manage, and it deals with most of them. You want to keep it as simple as possible. That's the key with this stuff. It's like anything. If it's not simple, you won't do it. If you're not, if it does get into a bit more complexity and you want to move into three-way models and things like that, there are some products out there that specifically focus on and link into MyOb and Xero and those sort of things that go straight to, okay, well, we'll feed the data in there and that'll help us push out a cash flow for that long. I would say, though, and Tam may disagree here, but I would say for 90% of businesses, Excel is perfectly fine.
Yeah, definitely agree with that. There is probably, if you do need something more complex, Spotlight reporting is pretty good, and Get Harvest is one that I've heard of but not yet dealt with. So I would try with Excel first, but if you do need something, those two might be something to have a look at.
Another couple that I've used with clients in that space around Spotlight is Calxa. Is another one in Castaway reporting. So there's plenty of them out there. They all do a similar thing. But before you go to that level, and they're all three-way forecasting, it gets quite complicated. Just a basic old Excel spreadsheet is pretty good.
Yeah, absolutely. And I think utilizing like your reporting program, so a MyOb or a Xero or a QuickBooks or whatever, you can actually dump out a lot of information to help create that Excel spreadsheet. So get it out in a CSV, and then you've got a lot of the, I suppose, the starting point for yourself. Yep.
We've just got a comment here from Brenton. Thanks, Brenton. Drawings, GST obligations, and principal component of bank equipment loans are a few of the bigger ticket items not captured in profit but affect cash flow. I think that's what Tam was talking about earlier, was to say, well, obviously there's plenty of things that are out there that don't impact our profit, but still take money out of our bank. And really the way to think about that is our profit is funding those things. So we need to, that's why it's important to have a profitable business, because without the profit, without more money coming in than going out, you can't fund loan repayments. You can't fund drawings. Well, you can for a little while, but eventually it catches up pretty quickly. So thanks, Brenton, for that comment. Guys, we've run 5 minutes or so over time. Thank you for your patience and coming along. We won't hold you up any longer. You'll get a copy of the presentation in your email pretty shortly, along with some of the other documents and things that we've spoken about during the presentation. Thanks very much for coming along. We really appreciate you making the time. Thanks, Tam and Amy, for the work, and Amy particularly on the presentation side of it, for making it look as good as it did. So thank you very much. And we'll see you all again in June. Please don't hesitate to reach out if you need anything.
See you guys.